Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Monday, and it's March 23rd. Hope you guys are having a great day today. At least good as one can have, right? These days, it's different. Um, let's jump right into it. We got no economic calendar, but our big thing will be the headline news. Most of the stuff on this week will be kind of irrelevant, of course, because a lot of the data we're getting are from a month or two ago. But the big one we'll want to watch this week, obviously, will be on Thursday with the initial jobless claims. There's reports that we could maybe triple to four times, quadruple the highest number we saw during the credit crisis. And during the height of the credit crisis, the most people that were applying for unemployment was around 600,000. And there's estimates that we could be seeing this over two and a quarter million people applying for unemployment last week. Um, so we'll have to kind of see what that will translate. That's the one report everybody's going to be watching for on Thursday. Move on to headline news. Stocks are down right now. Dow's down about 500 so far. We got some Fed moves today, which is helping out. Not so much the financial markets, or at least not the stock markets. It's helping out the bond market and treasuries, which you'll see here in a minute. But essentially what they're doing is they are basically saying they're doing anything they can to help smooth out the market. And one of the things that they are doing now is basically doing an infinite amount of quantitative easing, kind of like what we did before, but we had dollar amounts. This week they are purchasing mortgage-backed securities and treasuries in pretty massive amounts every single day this week. And basically it's a finite amount that they're going to go ahead and continue purchasing. This should help out mortgage rates, but unfortunately, we still got that issue with pricing with lenders where they're not going obviously according towards what we should see in the mortgage-backed security markets. Part of it is the influx of loans that they obtained earlier this month. Also, with the concerns about possibly being repaid, that they're putting different assessments into risk analysis with the repayments and stuff. Stocks are down because they are worried about the lack of federal government stimulus, that they haven't done any moves. There's been back and forth with the two political parties and can't seem to get anything through. And unfortunately, this is creating a bit worrisome for investors. And as you know, the American people need something to happen. And unfortunately, our government are letting people down as a result. New York has gotten pretty bad, where they have over 20,000 per the governor, over 20,000 confirmed cases. The National Guard was brought in to New York, Washington State, as well as California to help out in any capacity that they can. Um, but in other words, we're still waiting on the federal government from the Congress basically to get something drawn up and agreed upon and implemented. So unfortunately, they are late to the table. There's also some comments by the Fed member Bullard. He had mentioned that he thinks the unemployment could reach as high as 30%, which is quite amazing. But comments he did also state behind that is that these are planned because of the quarantines, uh, necessary, uh, necessary and planned on movements going into Q2. But in any case, this also kind of would spook the market of talking about the massive amount of how much of impact this could have in our economy and stuff. So let's see how this is playing on the bond market. Bond market is moving up quite nicely, as we said. We do have this opening gap, which at some point will probably get covered up since it opened up way up here. But right now we're up about 114 basis points, trying to break above the next resistance, which we're at quite high levels right now. So this should have some improvement in rates. I did kind of glance and did see a little bit of improvement, but because they're so far out of whack as it is, uh, it just helped out a little bit. All right, so and that's about 1 point. So some loans I was seeing priced between 3 and 4% are down to about between 2 and 3% right now. So it did help out a little bit. All right, so and then yields are down. Yields are down to about 0.77 range here, as you can see. We start up a little bit higher, about a little over 0.8, like probably around 8.4, down to 0.77, and kind of that's where we're sitting. It's kind of no man's land, so it has a lot of room in either way to grow or fall, and that could put less pressure on mortgage-backed securities. All right, so that's pretty much the wrap. Rates are a little bit better today. We should be better than what they are. But however, we do got some holdbacks from the investors or lenders out there due to they're trying to adjust their risk assessment in the mortgage-backed pricing in the mortgage-backed securities, as well as the influx of loans that they have in their pipelines currently, while they try to work their way through that clogged funnel there. All right. So, anyways, you guys in California you're looking to buy a refinance, please reach out. We are still working. We are still helping out people and have quite a variety of investors that we watch. And so, if one investor is a little bit better than others, we can help you out with that and get you the best price possible. Feel free to direct message me or email me. That email is the quickest turnaround response. And you guys have a great rest of your day, and we'll see you in tomorrow's video. Thanks for watching. Bye bye.